You keep hearing invest now, but what if you don't have a clue where to start? In the next 20 minutes, I'll give you a step-by-step plan to start investing in 2025. What to buy, where to open accounts, how much to risk, and the exact mistakes to avoid. No fluff. Let's go. Real quick, a story before we get technical. Last year, my friend Maya started investing with $100 in her pocket and zero experience. She made mistakes, panic selling in March, chasing a hot meme stock in May, but she stuck with a plan. Today, she's up not because of a single stock, but because she automated contributions, chose low-cost index funds, and learned along the way. That's the whole point. You don't need to get perfect. You need to start, learn, and keep going. What's changed in 2025? 2025 is different from 2015 or 2020. Interest rates and bond yields are higher than they were a few years ago. Crypto ETFs are mainstream, and AI-themed ETFs are everywhere. That means more choices and more distractions. We'll focus on what actually matters for beginners. Part 1, the foundation. Emergency fund. Money and mindset. Before you buy anything, build a tiny emergency fund. At least 3 months of essential expenses. Aim for 3 to 6 months when you can. This is your safety net, so you won't be forced to sell when a market dips. Debt and goals. If you're paying 20% credit card interest, pay that down first. For lower interest debts, like student loans or reasonable mortgages, you can balance paying them and investing. Then write down your investing goals: retirement, house, or wealth cushion. Your time frame changes the strategy. Mindset: investing is a marathon, not a sprint. You will see headlines, you will feel FOMO, and the best thing you can do is have a plan. That discipline beats timing the market every time. Part 2, accounts and where to start. Types of accounts: 401k or employer plan. Use match if offered, free money. Roth IRA, tax-free growth for many beginners. Taxable brokerage account, flexible investing outside retirement. Open the right account for the goal. Lower third, 401k/Roth IRA/taxable. Best brokers for beginners in 2025. For beginners, pick a trustworthy broker that's easy to use and low cost. In 2025, industry rankings put Fidelity, Charles Schwab, Robinhood, Vanguard, and M1/SoFi among the top beginner options. Each has pros depending on whether you want low-cost index funds, app simplicity, or advisor access. Quick decision rule: if you want lowest cost index funds, Vanguard/Fidelity. Beginner app plus easy fractional shares, Robinhood or SoFi. Auto allocation and PI systems, M1 Finance. Pick one, transfer a small amount, and learn the UI. Part 3, what to buy first, rule of thumb. For most beginners, the simplest, lowest effort portfolio is a core US total market index fund, or S&P 500 ETF, plus a total bond/index bond fund for balance. That gives huge diversification for minimal stress. Why index funds still win? Index funds are cheap and predictable. Vanguard and other major firms keep slashing fees. That means more of your money stays invested and grows. For beginners, low fees plus diversification beats hot stock picks. How much to allocate? Simple examples, plus chart. Conservative, 40% stocks/60% bonds. Older, near retirement. Balanced, most beginners 60% stocks/40% bonds. Aggressive, long horizon 90% plus stocks. Another simple rule: 110 minus your age, given equity percent. 110 minus age equals percent stocks. Adjust for risk tolerance. Pop up, examples for ages 25, 35, 50. ETFs and trending themes in 2025. Okay, trends. In 2025, a few themes get a lot of attention: AI and tech ETFs, infrastructure/semiconductor beneficiaries, green energy and crypto ETFs. Spot Bitcoin ETFs have been approved and are widely traded. These are interesting but riskier than broad index funds. Treat them as satellite positions, not your core. Practical allocation suggestion: if you want exposure to AI or crypto, consider limiting them to 5 to 10% of your portfolio until you're experienced. The core should remain broad indexes. Part 4, how to invest. Dollar cost averaging. Set up automatic contributions. Dollar cost averaging removes timing risk and builds habit. Even $50 a week adds up surprisingly fast. Rebalancing. Rebalance 1 to 2 times a year. If stocks run away from your target, Sell a little and buy bonds, or vice versa. Rebalancing enforces buying low and selling high. Graphic, before/after portfolio drift. Tax efficiency basics. Use tax-advantaged accounts first, 401k, Roth IRA. In taxable accounts, prefer tax-efficient ETFs and hold less tax-efficient assets, like bonds, inside retirement accounts. Lower third. Tax tip, put bonds in tax-sheltered accounts. Fees and expense ratios. Fees matter. A 0.5% expense ratio versus 0.05% might sound tiny, but over 30 years it eats a lot of returns. Favor low-cost ETFs or Vanguard/Fidelity index funds when possible. Part 5. Risk management and psychology. Volatility is normal. You'll see drops, sometimes big ones. The stock market is noisy short-term. If you panic sell after a drop, you lock in losses. Instead, review your goals and ask, is my reason for investing still the same? If yes, sit tight, protecting against one bad day. Keep an emergency fund, diversify, and don't invest money you'll need in the next 3 to 5 years. Short horizon equals safer assets. Avoiding common beginner mistakes. Rapid fire. Chasing hot picks. Don't. Ignoring fees. Don't. Overconcentration. Don't. Trading too much. Don't. Following headlines blindly. Don't. Part 6. Practical roadmap. Exact steps to start today. Step-by-step checklist. Here's your exact launch plan. Save 3 months of expenses. Open a retirement account, 401k/Roth IRA, and get employer match. Open a taxable brokerage if you want more flexibility. Allocate core index funds, 60 to 80% of portfolio, plus bond fund, plus small satellite AI/crypto, if desired. Automate $50 to $200 per month. Rebalance once per year. Example starter portfolio. Example for a 25-year-old who wants growth. 80% stocks, 50% total U.S. market ETF, VTI, 30% international ETF, 20% bonds, total bond ETF or short/medium-term bond fund. 5% of the 80% can be AI or an ETF if you want flavor, reduce elsewhere. That's it. Simple, diversified, cheap. Part 7. Final advice. To sum up, prioritize the basics. Emergency fund, low-cost index funds, automatic contributions, and patience. Trends like AI and crypto are exciting, but they should be seasoning, not your meal. If you like this, hit like and subscribe. I post weekly breakdowns of investing topics with real-life examples. Comment below. What's your biggest investing question? Fees? Cryptos? Retirement? I'll make a video answering the top comment. End card. Subscribe/watch next video. 5 common investing myths.